I wanted to kick it off and first just talk holistically of each of your companies and how they have interacted in the RWA space. I know Polygon, as an example, has had numerous institutions tokenize different assets and bonds on chain. I know Halborn, you guys are obviously looking at all the top code that's coming out in the RWA space. And Charlie obviously is looking at the data of everyone in the RWA space. So would love to just hear a little bit more about what you guys have seen on your side of the industry as it relates to RWA.
Sure, I can go first. Like Nick said, we pretty much have a view of almost every single protocol in the space, and so it's been overall really interesting to just see the ebbs and flows of first the huge run-up of market maker loans and loans to trading firms that were unsecured, a little bit more risky at earlier in the cycle of last year. And since then, all of that's gone down a lot. It peaked at around 1.5 billion and went all the way down to recently a low of 20 million. So we can kind of call that crypto's first credit crisis. And then since then has a lot more of real-world assets and real yield and off-chain collateral has started to take place, and that's now grown up to around $450 million that we find ourselves at today. And so it's just been really interesting to see the different composition, ebbs and flows of different things, and happy to go into more details on that if you want to, Nick.
No, that's good for now. We'll skip it over, but we have more questions that'll dive in there.
Yeah, sure. From a security perspective, anytime you're doing a transaction that doesn't live and die within the same ecosystem, and you start using things like bridges and oracles, that's when you're opening yourself up for different types of threat vectors and vulnerabilities. So what we're seeing in this space is, a combination of a lack of maturity in some respect from a control perspective, a lack of budget in order to really hire like a well-versed security team. And then also there's this speed to market. So there's a lot of checks and balances that you'll see in the traditional finance world that you're on purpose and by design are not seeing in the crypto world, which is leading to unfortunate things like hacks and loss of funds, which is leading to loss of reputation, which is leading to loss of trust in the ecosystem. So it's really a downward spiral. So unfortunately, I don't really have great news for everybody other than there are a lot of different projects and a lot of different initiatives to try to secure the ecosystem and to try to instill capital, whether it's the different layer one foundations, giving grants to different projects to really beef up their security. Companies like Halborn and a lot of our competitors are also upskilling and finding really great talent. So things are looking on the upswing as far as security from an educational perspective, and then also from tooling as well. So there's a lot of really cool tools that are being built, some in stealth, and then some obviously being launched to market.
Yeah, and then Polygon, really think of it as the infrastructure layer, right? So similar to Ethereum, bottom line is you're going to want to tokenize assets, and the question is, where do you do that? And generally speaking, right now, you can go ahead and do that on Ethereum. You could do it on other, L1s. But if you're looking for a cost-efficient way to tokenize these assets, a way that they can be transferred in an efficient way and in a fast way, then you start looking at generally either some alt L1s or some layer 2 technology. Generally speaking, when people are looking at Polygon, most of the reason is behind the fact that we've been around for a while. There's a lot of tooling in the space. There's a lot of DeFi infrastructure on Polygon. So there's a lot of alternatives in which you can actually have a lot of users as well as a lot of tools on Polygon. And so that's why it's interesting for RWA.
Nice. Thanks, guys. So I want to kick it off with a little bit of a history lesson here. In the ICO craze of 2017, we saw a proliferation of tokenized securities that none of those projects exist anymore. What do you guys think is the reason that initial push for RWA failed, and what has changed in the industry that has opened up the possibility for what we're seeing today?
I'm happy to start. Worked through 2017, worked with a ton of companies looking to do ICOs and other token distributions. And you basically get the SEC that hands out a bunch of subpoenas in the beginning of 2018, crashes that entire market. And everybody starts looking at okay, what do I do now? And everybody's like, okay, let's go tokenize securities. But there was two issues with that. Number one, a lot of people were selling them to people who had the belief that they were just like crypto. And so they'd buy them, and they would basically be like, okay, these things are going to shoot up in value, except they're just securities, and there's literally no reason that they're going to do that. And so that was kind of the first issue with that. And then the second one was I'd call it misunderstanding that I don't think exists as much now at all on what a tokenized security really is. And things like, hey, this is now like available to the world. And the answer is like, you could take any security and make it available to the world. The question is just like, what regulations are you going to comply with? It doesn't need to be tokenized to make it available to the world. Or people are like, oh, it's easier access. And the answer is like, I can create a digital platform and a digital security that isn't on a blockchain and sell it like really easily. But things like 24/7 trading, increased liquidity, coding regulatory stuff into the tokens or the infrastructure, those are all things that actually are better when it comes to like on-chain securities. The problem is none of that existed at all in 2018 or 2019. And so people were going ahead and trying to do this, and you just like hit a roadblock after roadblock. And even if you get through and you're like, okay, I've tokenized this, I've like created some like Frankenstein way of trying to like make this work, then you're like, oh, so now one of the great things is you can like trade this with like transparency and like very easily. Where? Well, nowhere. And you just literally didn't have the infrastructure to do it. And so you started seeing, players like Securitize, Tokeny, still around now, go ahead and saying, okay, we need to build like regulatory infrastructure for this. But it was at a point in time where, frankly, interest started dropping because the infrastructure wasn't there. You'd go ahead and try to tokenize a security, and you would literally pay like 10x what you would pay just to sell the security normally. So people kind of lost interest. The good thing is we've basically had platforms that have continued to build over the last 5 years or so, to a point where now we're in a like much better spot when it comes to tokenized securities. Then you also have the DeFi ecosystem that's kind of built up. And so things have kind of like changed since then from like an infrastructure perspective that didn't exist back in 2018, which is why it all flopped.
Yeah, no, 100%. I mean, I think from my perspective, the fact that the DeFi markets have matured this substantially and we have this much liquidity that continues to slosh around all these different L1s and L2s, it's created what is effectively demand for real-world assets. I think in 2017, 2018, there was this push because basically everything else in the space outside of Bitcoin and ETH was not of high quality, but there was really no demand. There needs to be like a fundamental reason to bring these assets on chain. And now with the growth of stablecoins, we think there is a substantial form of demand now. When you look at the difference in stablecoins between centralized and decentralized, there's a huge gap on the TVL basis. And we believe RWA is one of the answers there. So that's a big change in demand, I would say, that sort of opened things up for the space. Charlie, I want to go into a point you made earlier about sort of the ebbs and flows in the RWA space. As this, I would say, season 2 of RWA started taking off, we really saw like an explosion of non-recourse lending to market makers. Can you talk a little bit about why that market exploded? Obviously, there was a lot of failures on the centralized markets, but what happened with that space? Why did it grow so quickly, and what sort of changed in terms of the balance of collateral in the real-world asset markets?
For a while, a lot of the borrowers like the orthogonals, Wintermutes, Jumps, Alamedas simply couldn't access regular credit markets from banks. If you try and go to Goldman Sachs and say, hey, I want a loan to trade crypto with, they're going to look at you and like just basically kick you out, but in a very nice way. And so this led to a lot of, even though they were fairly credit-worthy institutions at that time, they had a really hard time getting access to capital, and so a few people realized this, namely Maple and TrueFi, and started offering these products to a lot of investors. And because they couldn't get that capital elsewhere, they were quite attractive loans given the creditworthiness at that time. And then what happened was that in the bull market, everything's just going up. These trading firms are just making more and more money. Rates, more and more people get into the space. You get folks like Genesis, FalconX, all these other people who come from TradFi trying to get into it, this type of lending as well. And it just naturally creates too much liquidity in the space, too many loans chasing too few sources of yield. And when the market turns down, you just end up seeing all of that collapse. And so that's really the fundamental reason why this sort of credit crunch happened. And it's a pretty standard liquidity cycle that happens in traditional markets. But this is the first one that we've seen in crypto. And it's just funny to see DeFi speedrunning a lot of things in TradFi.
Yeah, 100%. I want to dig in a little bit more on the value side of real-world assets. And anybody can answer this. How would you guys describe the value add for traditional financial institutions and why they're looking to participate in these markets? And how would you think of the value add for permissionless blockchains that are looking to adopt these assets?
On the latter part, so we've spoken with a few different traditional institutions and they've all sort of said that given the regulatory environment, right now they can't use public blockchains like Ethereum and Polygon and all these other ones that we all love. But that is actually the end goal, because right now they have private blockchains that they tokenize assets on and do their pilots. But at the end of the day, that's it's just a slower database and isn't really what blockchain was really meant for. And so they all kind of see the vision for why they would want to use blockchains, and that it's composable, it's faster, cheaper, and everyone can kind of trust it because you have a bunch of parties that don't trust each other, and they can all settle things in one layer that's open, secure, and can run automated code on top of it. But it's just, unfortunately, the regulatory environment is blocking most of that at the moment.
Yeah, I mean, and also in some respect, it's FOMO, right? Like, a lot of the banks that I'm talking to don't necessarily know or believe in it. It's more about hedging the risk because some of their clients are asking for it, and some of their clients' clients are asking for it. So they know that if they don't adopt that, then they're going to become the next MCI, Blockbuster, whatever it is. So privately behind closed doors, I'm getting a lot of, I don't really know if this is the future, but I have to do it because the rest of the world is moving towards this. The other piece of it also is just the technology itself. Like, I'm seeing a lot of digital ledger technology replacing internal infrastructure. So it's whether traditional GL systems are on mainframes, how can we use this now? And again, it's not permissionless, but it's more permission chains between the banks, so we can maybe do more efficient and cheaper clearing and settlement, and not necessarily replacing SWIFT, but maybe potentially maybe replacing SWIFT. But this is some of the conversations that are having, because again, a lot of the people that are working in the banks are also younger, so they're also excited about the technology. So they're the ones that are pushing it, and then the ones that are on their way out. So it's just also just a cycle of the boomers leaving, and the Gen X, not even Gen X, the millennials and the Gen Zs kind of coming in and saying this is the future and we need to adopt this.
Yeah, I mean, I think there's, I would call right now still a testing phase, even though sometimes you see some pretty big things coming from institutions in terms of what they're tokenizing. It's still testing in the sense that first of all, it's permissioned in some way. That's probably the biggest thing, is that you're not seeing anything that's completely permissionless. Even if it's built on a permissionless chain, there's some type of permissioning there so that it doesn't just go wild. And so that's probably the biggest thing that they're doing. But the reason they're doing it now, because you're kind of well, if you need to permission it, why even do it? And the answer is because you start learning things from it, right? You start learning how people are interacting with it. You start learning what kind of tools need to be built with this so that they can, our customers can use them better. There's some interesting things. For example, let's take Franklin Templeton. And it's actually perfect timing, right? Because they literally just announced having launched on Polygon Labs, on Polygon. And the reason why to me that's so interesting is because you're at a time where right now, when you think of the banking situation, nobody wants to keep funds in banks. Even if they do want to keep funds in banks, they probably can't keep funds in banks because they can't get bank accounts. And then you kind of go look and you're oh, here's this tokenized money market fund that I can purchase. Whether they accept USDC right now or whether they will accept USDC in 6 months or 12 months, what it shows you is a future where you can be holding money market funds with a reputable financial institution without ever touching the traditional banking rails, because you are transferring USDC in exchange for this tokenized money market fund, for example. And so while that's a small little step, it's kind of the beginning of what you can kind of see something more open happening, something where you don't need to touch the traditional banking system, which I think a lot of people don't want to do or can avoid doing and would prefer to. And that leaves aside kind of some of the other things that you mentioned, right, which is just the transparency, the efficiency, and all those other things, which are all kind of, as things open up, as DeFi one day maybe becomes more accessible, when it comes to kind of these types of assets with big institutions actually being traded there. This is all kind of the initial step to making that happen.
It's also market opportunity. I've talked to smaller regional banks, and they're we're seeing wires going out to Coinbase. We're losing profit. We're losing customers. So it's just the next evolution for them to keep their customers.
Yeah, just to add on to that, I mean, a lot of the institutions that we speak with are trying to find ways to add values for their particular customers, right? So they're trying to keep the business that they already have, selling products, selling structured products, different instruments, to their customers, and then finding a way to drive value to their customers with those instruments, whether it's getting leverage against them, being able to trade them on chain, a number of different things. And it's been a big educational process with the institutions as they're trying to figure this out. I want to kind of pivot here and spend a little time talking about the legal and regulatory landscape. There's been a lot of chatter from the SEC. There's been a lot of pressure from Congress. Gary from the SEC has looked very silly over the last few months. What is the future of crypto in the US, given the existing regulatory landscape? Because it currently sounds like all the main companies are going to leave. But I'm hoping that's not going to happen. What's your take, Marc?
Yeah, I think you need to think about this from like, so first when you think about the SEC, yeah, they're going to continue to like attack like every company in the crypto space. It's just like reality. It's what they're going to do. They were working on it anyway. They decide that they're going to work on it even harder once FTX happens, and they're going to continue that. And Gary's still in office for several years, and so we're going to continue to deal with that. And so the question is like, what do you do? And the answer is, right now, most of the time, you say, what can I structure outside of the US? That's just reality. The good thing is that I'd say over the last like 3 years, the crypto industry's built like a pretty strong like advocacy and lobbying group that's like definitely not the banking lobby, but has become like pretty strong. And I'd say like there's like a long-term strategy that is, okay, let's work with Congress and let's try to actually get some laws in place that are going to help here. The problem is we're literally like 5 years out from like anything happening. There's nothing that's going to happen over the next 3 years, like guaranteed, in anything like meaningful way. Maybe stablecoin legislation, like really long shot, like maybe, but like centralized stablecoin, and like that's it. But like nothing else. And so 5 years is like a really, really long time. And so the question is, what do you do before that? And so I think like there's kind of I put in the category of like survival mode that basically says stay out of the US until the industry can properly, I think, bring the regulators back into like control, until Congress actually has time to act. And I think like that's like the last thing that I'll say is like the benefit of the US is that you have like a strong court system where you can deal with this. It takes a while, but there's actually like an avenue, and there's constitutional protections that are very meaningful. You just need to be able to get there. And there's definitely like Gensler's biggest mistake has been that he has like really brought the industry together in a way that like has it extremely energized to fight like it has not fought before, and it's like a massive mistake. Jay Clayton in the last administration was way smarter. He's basically like, I'm going to block everything that you're going to do, but in like a very chill way, and like you're going to keep going along, and you're never going to get anything done because the institutions won't want. Gensler did not do that, and I think it was like a big mistake actually on his part.
I mean, we came from a world where Bitcoin and ETH were seemingly becoming approved as commodities, and now the SEC is sort of taking a different view on that. Specifically on the stablecoin side, which you alluded to, maybe help us understand sort of what's coming down the pipe on the stablecoin side of things. Obviously, stablecoins are a very important aspect for real-world assets to scale, and maybe sort of talk about it in the context of stablecoins we're familiar with, like Circle, Maker, and maybe even Frax.
Yeah, I mean, I might diverge from that slightly, but not far, which is like centralized stablecoins. And then we'll go like the other end of the spectrum and basically say, let's just use like Luna as like the example over there. And then we will put like DAI like in the middle of that. And basically the way that it's being looked at is like, okay, we really want legislation passed on centralized stablecoin. And the reason for that is actually because it's easy. Simple audit, backed one-to-one. The riskiest assets you can hold are like short-term treasuries, and done deal. This isn't actually hard if like there was any like political desire to do anything in the US. Like it's a pretty simple thing that like everyone pretty much agrees on anyway. Then you get to like the other end of the spectrum, and you get to basically like Terra Luna blowing up. And what that resulted in is, how can we ban this? And I think we've gotten to the point where like we're not going to get a ban, but we probably will get like what we've seen in bills already that have been drafted is like a moratorium.
And the way the language is pretty much drafted, and it's intended to exclude things like DAI, which I'll get to at the last point, is basically to say, and they refer to it as like an endogenous stablecoin or something along those lines. Basically, the idea there is to say, if you have like a native token that is also backing that stablecoin, so like the stablecoin exists on the blockchain, the native token of that chain is the one that is backing it, then there's going to be a moratorium on developing those. And the idea being that like maybe it's possible, I guess, to develop something that doesn't blow up, but like fundamentally, like literally doesn't even make sense that it can't blow up, because like the second a spiral starts, like it's done. It's just impossible. That win is actually really important, limiting it like that, because then you've got something like DAI that survives, and like why is it important and why is it like not obvious that DAI would survive? And it's because its ultimate backstop is a native token maker on its chain that is essentially backing it. And so like essentially what the regulator, the policymakers have been looking at is, okay, we're not going to stop that. And the reason is because most of it is backed by some kind of crypto assets, other real world assets that are maybe like off chain, but there's like real value there that should cause people not to lose trust, right? If it's 80, 90% backed, primarily backed by like real assets, like you shouldn't look at that and be like, oh, you know, if 10% of people pull assets out, like we should pull our assets out too, which frankly was the only thing you could do the second you saw Luna blowing up. And so basically then you can have a native asset that actually backs it, but it's just not going to be the primary thing backing it. And so like that's kind of, I think that we're very far away from seeing anything done on like the DAI side of the world, like very far away. It's like not hardly being thought about. Right now it's basically just being protected. Whereas like I think Luna, the answer is like it's just not even politically viable to try to like protect anything that looks anything like Luna. But let's not ban it, because like we shouldn't ban experiments, right? And like there's more going on there than experiments, but like let's not ban experiments as a result of something bad going on. And then let's deal with like the centralized stablecoins that everyone agrees on.
Dave, maybe you could talk a little bit from your time at BNY and sort of how you guys were thinking about this space and sort of what considerations on the regulatory side you guys had to take into consideration to actually start building.
Yeah, I mean, you know, when we were looking, and again, I can't talk, you know, the specifics as to like what we were actually working on. Just going to give you like just some of the mindset. But, you know, when we started looking and thinking about things like tokenization, we weren't like getting super deep or super technical. Like, you know, it's baby steps. It's like tokenizing bonds on a privatized, you know, internal blockchain. You know, we're not doing anything on the mainnet. It's literally like, you know, toe in the water. And you know it's by design, because you know we're risk averse. We are, you know, heavily regulated by, you know, every agency, so we don't necessarily want to like, you know, start doing things that are, you know, deemed to be too risky, you know, especially for a bank like ours. So it's really testing the technology first in some respects. You know, as far as like, you know, stablecoin, you know, I think it was public or not, but like, you know, our involvement would be more like from the custody of the real world asset, not necessarily like the issuing of the stablecoin. You know, but listen, you know, from a research perspective, you know, that was potentially on the product roadmap. You know, maybe 3-5 years out, like a stablecoin that's, you know, backed by, you know, assets held by, you know, the, you know, world's largest, you know, custodian. Like we custody, I think, like $43 trillion. I mean, to me, like that would have been amazing for the ecosystem. Like, you know, it's not Tether. Like that's like it's people trust. I think it would do a lot for.
Sounds like maybe we should talk to BNY Mellon. On another note, Dave, I want to sort of take us back to you and discuss a little bit more on the Halborn side. I want to get your perspective on the role of an auditor. Obviously, there's been a lot of hacks over the last 12 months and pretty much historically ever since crypto started. What's your advice to founders? What's the role of auditors in the context of these projects? What would you say to founders?
I mean, honestly, in some respects, like I don't even like the word audit, right? Like audit brings this notion of like an attestation, like, you know, a normal audit. Like we're not issuing an actual opinion. It's really a security review, and you know, here's the vulnerabilities, and you know, we looked at it. That's the audit report. It's not necessarily an audit. It's really just an assessment of the code, and we're looking for vulnerabilities. And it's really one part of the stack. What we're finding is a lot of projects, and I'd say a majority of them, are just completely relying on outsourced auditors to come in and look at the code. So you're looking at firms that are not sitting with you. They're not the builders. They don't really necessarily fully understand to the depth that you do of what your project does. They're looking at it for 3 weeks, 4 weeks, 2 weeks, depending on the size of the code. And there's this expectation like that's the only thing I need to do. It's going to be the silver bullet. I had Halborn, I had Certic, I had QuantStamp, I had OSSEC, or any of the other firms, the tier 1 firms, to come and look at it, and we're good. That's not the case. It really should be one piece. You should have a fully fleshed out internal security team. You should have a CISO. Don't just rely on developers. One of the things when people ask me like, well, how do I trust this project versus that project? One of the things I do is I say, look at the team. Do they have security people? Sometimes you'll see, oh, they have a CISO, but if you look at LinkedIn, it's like this is their first job in security, and before that they were just a developer. Projects should have a CISO that has security background, that really understands things like CI/CD, continuous integration, continuous deployment. There's so many other vectors that could lead to an exfiltration of funds, not just a code vulnerability. Most of the hacks that we see, in fact, I think about 50% of them, are not necessarily related to a smart contract vulnerability. It could be something on the front end. It could be one of the employees have been socially engineered, just like the Ronin hack, and they're stealing keys. There's so many different points in the transaction where somebody can get compromised. And it's really people and process. It's not just technology. So what I would say is don't look at smart contract auditors. I don't even care what they tell you. Even if you talk to one of my sales guys and they say, this is all you need, you don't just need auditors. You need a lot of other things besides an auditor.
One thing that you said that I think is like really interesting is I was talking to our CISO about this, and one of the things he mentioned is the leaning in the space to like look at like Web3 expertise or Web3 auditors and totally forget about like the security practices that we've learned in Web 2, and not just those practices, but also like the expertise that you have. Like to your point, right? Like a lot of the hacks are actually like Web 2 standard hacks that are happening, and that is what is giving like access to assets on a blockchain. And so I think like having Web 2 security expertise is something that is like not at all looked at enough in this space as being a benefit that actually is a real benefit.
Yeah, 100%. I mean, just looking at architecture, like looking at things like network, and I'm not going to too technically deep here, but like looking at segmenting your networks and looking at things like key management. There's so many other things that are in just a regular Web 2 space. You might have to strengthen it and look at it a little bit differently, but you're 100% right. Like those are attack vectors. When I was talking to certain projects, they're always like keys. Keys are important, and you definitely have to protect your keys. And there's obviously HSMs and multi-party computation and all these nice little buzzwords, which is also causing confusion in the market because people are like, oh, I'm using MPC, so I'm good. Well, that's just a protocol. There's different, versions of MPC. There's, different ways to implement it. There's different ways to store the key shares. It's not just saying, I'm using MPC, I'm good. And that's unfortunately where I see the market moving. It's now becoming more of a buzzword driven. I'm using so-and-so and they're using MPC, so I'm good. But, it's really things like the web front end. Like look at the Badger DAO hack. Had nothing to do with the Web3. They just hacked the front end of the website and you were giving token approval to, a malicious contract. Nothing to do, anything related to Web3.
Yeah, and then you have all the economic attack vectors that need to be considered as well.
That's actually a very good point. Thanks for bringing that up. So, a lot of times the smart contract auditors, they're just solely focused on code. You have to also get DeFi experts and financial experts to really understand what is this project trying to do from a financial perspective, because a lot of the vulnerabilities are just poor coding from a business logic perspective that are not going to get picked up by automated scans, that are not going to get picked up by, no, I'm not aging anybody out, but a 22-year-old who's just been coding for the last 3 years that is just looking for buffer underflows and just your typical stuff that you would look for in security. It's understanding from a business logic flow perspective, is there a point of vulnerability just from a process perspective? Thank you for bringing that up.
Thank you. Really helpful. Just one more question that I have to keep digging in here. We see a lot of projects that have worked with multiple auditors who have audited different parts of the stack. We saw this more recently with Euler. How should founders reconcile? Should they be only working with one auditor across every single smart contract? Or how do you actually work with multiple and not have overlapping coverage issues?
Well, number one, I mean, you can have the same code base audited by multiple auditors. Some of them, are specialties in DeFi, and some of them are specialties in this. So, if you have the funds, get multiple opinions. And then, it's also, like I said, building out your internal team. Again, some auditors have specialties in certain areas. The other thing, too, that I think most people don't realize is, oh, this project was audited by so-and-so. Well, great. That was 3 iterations of the contract ago. It's been updated 3 times since that contract. But the problem also is us as a community, we're not demanding better, accountability from the projects. We're not actually checking, is this version of the smart contract that I'm interacting with the same one that so-and-so just audited? Even some of our clients do that. They'll come in, they'll get an audit because it's optics, it's security theater. They can flash it on their website that we've been audited by Halborn. And we've had to protect ourselves a few times because there have been maybe vulnerability within a client that we've worked with like 6 months ago, and we did an audit 6 months ago, and we have to, in a very nice way, without shaming the customer, let everybody know, hey, that's not the contract that we audited. So it's also us as a community, not just turning a blind eye, to what's actually going on, and do your proper due diligence.
There's also the part on the legal side that you're probably not hearing, right? Which is that historically auditors have had all the power when it comes from a negotiation perspective, and as you get into a bear market, there's still some discrepancy here because there's just not enough expertise. But there's definitely a lot of firms as things shift where that negotiation power shifts. And right now, the problem with security auditors is every contract has them on the hook for absolutely nothing, under almost any circumstance. And it's a very difficult thing to negotiate because the bottom line is you can't expect every little bug to be caught. It's just not realistic. It's just impossible. But there's also a certain standard that needs to be satisfied. And going through and rushing through and being I audited this and I made a few recommendations and that's it and so we're done. Shouldn't be something that folks should be satisfied with and that security auditors should be able to get away with. And so I would just suggest that when negotiating these things, people need to push a lot harder on the legal side of things when they're negotiating these contracts rather than just letting them get away with pretty much anything.
So I don't disagree. In fact, so I'm a lawyer too. So I had a conversation this morning literally around limitation of liability indemnification. And the client was adding indemnification in, and I removed it. And they're, striking the limitation of liability, and I'm adding it back in. And the conversation I had with them is, listen, you're beating me up on price. You're expecting me to do I'm just going to make up a price. You're asking me to do a smart contract audit for $50,000, but yet you're asking me to potentially be liable for $3 million. I go, that doesn't make sense. You want me to be liable for $3 million. Your smart contract audit is going to cost $500,000 because now I'm taking on risk. You can't have it both ways. Don't beat us up on price and then ask us to take on liability. I'm happy to take on some form of liability with caps, but then your price is going to raise because now I'm in fact providing some sort of insurance.
Love it. I totally agree with that. Love it.
We've seen a reaction of this as DAO-based auditors, right? That they have basically a pool of money in the treasury that acts as an ultimate. I think Sherlock is an example of this. What do you think auditors like yourselves can do? Is it an insurance-related thing? Is it sort of charging more for that type of sort of indemnification? How do you guys think of that?
Yeah, listen, there's different, I like to look at Halborn as running in the opposite direction from our competitors. They're running, in my mind, in some respects, down market, we're running up market. So that's some of the things that we're trying to do as an organization is we're trying to provide a total protection. So we just partner with Chainalysis, for example. So now you can get a package of Halborn and Chainalysis services in one, where we do up to X and Chainalysis does incident response. We're also talking to a few insurance providers as well. So that way you can get the insurance, the incident response, and the auditing all in one package. Because what we're trying to do is we're really trying to protect our clients. We're not just in here for a quick buck to do a smart contract audit. We truly believe in this technology. We want it to grow, and we want to instill trust in the ecosystem. And part of that is providing that end-to-end protection. And it all comes down to risk management. There's risk acceptance. There's risk mitigation, and there's also risk transference. And that's part of the insurance. And that's just part of a proper risk management framework.
Awesome. Thank you, guys, for that. So as we kind of look to wrap up here, I have a couple final questions. And Charlie, I'm going to kick it off with you. There have been numerous institutional reports and predictions on the RWA space. We've seen things from Citi more recently to Fidelity to Franklin to BCG. In fact, BCG recently put out a report that has an expectation of 16 trillion of traditional finance assets getting onboarded on-chain over the next 10 years. My question for you is, what do you think is the number one thing that will facilitate and scale that growth that doesn't exist today on-chain or off-chain?
I think we need to see just much higher quality assets that are better priced come on chain. At the end of the day, if Wall Street has a way of making money by investing in these assets, they're going to coerce, their legal teams and their back office teams to actually make that happen. And so at the end of the day, it really just matters about can I by investing on this on chain, this asset doesn't exist anywhere else, or maybe it's just cheaper. Can I make money on this? If the answer is yes, then they'll make it happen. They'll put as much money as they can into it. And in my view, that's the number one thing that's stopping adoption right now. It's just the lack of good pricing, lack of good asset quality.
So from my perspective, obviously security is one issue, but I think the other issue also is just lack of maturity in the ecosystem. Again, coming from where I came from, working with certain vendors, they did not meet the control environment that we would expect from a large financial institution. So we had to make a lot of concessions for working with certain projects just because there was no enterprise level tool. Like there's no enterprise surveillance and enterprise risk management tools and how to do capital reserve. And there's just so much stuff that the traditional banking system is used to. And while there's a lot of, interesting projects that are trying to attack in the space, they're not necessarily doing it at the enterprise level, not building infrastructure, from a composability perspective and from a privacy perspective. Just to give a quick example, if we're looking at node providers, at a major bank, unless we build it ourselves, we have to work with a node provider where we're now making API calls, and that node provider now has access to all of our queries, so they know which wallet addresses we're looking at. Okay, so now we have to do a deeper due diligence of that particular provider, and then we find out it's a team of 15 people who, they're do new background checks, and there's no offices, and they have laptops, and they use their personal email on it, because you can't have a restrictive environment because that's just not who we are as a community. And if you start restricting it like TradFi, then they're going to leave and go somewhere else. So there has to be enterprise level controls and enterprise level tools in order for TradFi to really feel comfortable to really dive into it, from my perspective.
I'll just default to regulatory. I tell my team this all the time, and probably because it's PTSD from 2018, 2019, but I think the real world assets is the quality of the assets is a really good point. I think we were saying that in 2018, 2019 as well, though, unfortunately. I think that is a prerequisite. It's just not helpful if you've got poor assets that nobody wants to buy. Of course, it's just not going to work. But from a regulatory perspective, I think that you can tokenize things right now. You can bring real world assets on chain, but there's just limitations, whether it's geographic limitations or technical limitations that you need to put in place. I've always said that the time frame for when you see a proliferation in the way that we'd want to see free flowing assets is literally 10 years out, because that's realistically you can just look at time frames from Gensler's in office. You've got 3 years of nothing getting done, guaranteed. Doesn't matter that you're hey, we're actually trying to do this right. Irrelevant. So you're 3 years out on that. Then you got somebody else comes in who's going to have no idea about any of this. So there goes another year that goes by. Then you're oh, I've got some good ideas. Let's start talking about this. And then you're oh, okay, I'm at year 6 from now. And then you're okay, well, we got to get some kind of regs actually passed, have comment periods, talk through it, or legislation at that point. And you're a solid 8 years by the time that actually happens, if not 9 or 10. And so that's the realistic time frame where you see regulations that say, okay, we're going to look at blockchain technology, and then we're going to look at those benefits, the intermediaries removed, the transparency, the efficiency. We're going to recognize those benefits, and we're going to actually create laws that recognize them. And that's going to take a very long time to actually have happen. And when it finally happens, I think is when you're going to see things really take off. But I think everything that happens until then, frankly, extremely important to continue to build infrastructure, knowledge, to finally get there. And frankly, it's those who can build over that period of time and sustain over that period of time that are going to do really well.
Just a couple points on what you guys were saying. Charlie, on your point of just asset quality, I think the reason that it sort of started that way is because most of the real-world assets that were being tokenized were basically there to create a high-yield permission pool. So it's retail demanding high yield that's already used to the absolute most Ponzonomics that exist in crypto that are depositing in some of these pools, right? And so that's really where you got that. My answer to the question is that I think there's going to be an entire update across protocols that are rebuilt from the ground up to actually operate with real-world assets. I think a lot of existing protocols were really built for decentralized native assets. Their governance were implemented around managing traditional digital assets. And I think we're going to see like a whole proliferation of money markets, stable coins, borrowing and lending applications that find ways to integrate with real world assets and drive a lot more sustainable value for their users. So that's my answer there. Last question for you guys. Please leave us with one prediction for the rest of the year, and please make it controversial.
Right now, we see just about $500 million of real-world assets that are outstanding around there. I think easily that's going to be set to double, just because we talk to so many teams across the industry that are about to launch and see some truly amazing, unique projects out there, along with the capital that is ready and willing to be deployed into a lot of those. Just to give you a sense of it, there's maybe 10 active, like very active protocols at the moment, and in our Notion database of what people we talk to, there's at least like 50 more that are about to come online. And so I think it's gonna be a really exciting time for the space in general.
So controversial, not in a good way. I don't think FTX was the last one. I think we're going to see some other major ones, come too, which won't help on the regulatory side. So maybe 15 years.
I love that. I'll leave you with a prediction that I heard somebody else share that I thought was absolutely ridiculous, but I would not be surprised to see this happen. Arthur Hayes, about 2 days ago, predicted on a Twitter Spaces, that Ripple was going to be trading at $3 by the end of the year. So take that with what you will, but would not surprise me. Thank you, everyone, for coming. Really appreciate it. We'll be around for the next hour or so. Thanks for coming.